statistically speaking, if over enough period of time, your odds of doing well are very, very much in your favor. That's why, real estate has been the number one generator of wealth of millionaires in this country. The tax laws are favoring real estate. It's one of the very best, collateral sources to get good leverage. And then just in general, it goes up over time. It does cash flow.
Welcome to The Path to Wealth, the show about well-being, fulfillment, and financial freedom. And I'm your host, Hannes Henschel. Welcome back to The Path to Wealth. I'm your host, Hannes Henschel. Joining me is Andrew Rosenberg, a seasoned investor with over 35 years of experience, specializing in oil and gas, real estate, and equities. Andrew currently serves as a partner at the Atelier family offices. With a notable 12-year track record in real estate, he brings a wealth of knowledge to our conversation. Andrew has a unique perspective, having been involved in both passive and active investment roles, and possesses a deep understanding of the perspectives of both sides, investors and managers. Additionally, Andrew hosts Simply Sundays, a commercial real estate meetup. We're thrilled to have you on the show, Andrew.
Oh, thank you very much, Hans. It's a pleasure to be with you here this morning. Looking forward to chatting with you.
So, where did your financial journey begin, and where did the mindset to build wealth, to compound and invest come from? Is it something that is maybe second nature in your family, or is that something that came through your own journey?
Oh, okay. Yes. Yeah. It's definitely a family background. So all of my family, everyone's entrepreneurs. We don't really do W-2s. So it's very much more of a self-control mindset. We don't really look to depend upon others. And then when I was 13, a bunch of family friends pulled their money up together and gave it as a gift with the stipulation that I must buy a stock with it. So you have to remember, this is pre-internet, so it was a little different back then. So it'd be flipping through, at the library, a binder of printed out value line newsletters, and reading Forbes and Fortune and magazines. Print magazines. When I tried to tell my son this story, it's like, a magazine. I'm like, yeah, he doesn't understand a pre-internet era. And it was part of it was to learn a new skill, to emphasize investing now to enjoy later, that type of thing. And so we did the research, and I'm generally a very risk averse person. You have to remember, this is a long time ago. So this was my first stock was Jam Smuckers. It was a jams and jellies company, and
How did you pick it?
It was at the time it was undervalued, and it paid a dividend, and it was a product I could see in the grocery store, and I liked their products, and the valuation was compelling, and I bought it at 60, and it not too long later went to 80, and I was hooked. I was like, wow, I can make 2 phone calls and make money. And this is back in the time when you had to pay a large commission, and there was no internet trading. This is, my father had to make a phone call for me because I was a minor, and then it became stock trading in from 13 years on all through high school. And my father's probably favorite day in life was when I was 18, so he no longer had to be the custodian of the account, because I would leave him Post-it notes like, remember, in the morning, you're supposed to buy this stock at this price, and a couple of times he forgot, he was busy with work, and I would get angry with him, and he's thinking, my God, you're 10 shares, you're giving me all hell, and here I am trying to run the actual business that, puts a roof over our family's head, and I'm leaving him Post-it notes on his steering wheel. Remember, you're supposed to call the broker today, and you put in the bid at this price, not a point higher. And it's something we still laugh about to this day. He's quite glad to not have to be my unpaid stock advisor anymore.
So how did you make sense of that? Like, did they teach you how to evaluate it?
No. They said, go figure it out. Doing is the best, teacher. And of course, it wasn't like we just picked up the newspaper, and picked a stock. So we read for a little while, and it was good because, you start following a company, you're reading the news, you get the annual report in the mail, and back in the day would be this nice, beautiful piece of paper bound annual report, and you would read about the company's history and go through the financials, and it was a good education. So it was one of the probably one of the shrewdest things my relatives had ever done together. That was a very smart thing.
I think so too. But I think there's also the way you picked up on it. It's like the way you got hooked.
Oh,
I think because I had a similar instance where the local bank gave us, that is already internet time now. So there was a fake account trading real stocks. And they gave
okay.
us like 50,000 euros. And I had a small team with other students. We were together. And I must have been around 14 when we did that. And initially I was really excited to do it. But it was a nationwide competition. And we were doing pretty well. We had, that was like in the early stage where solar panels came out. And so we had a couple solar companies in our portfolio. We did pretty well for some time. But I eventually lost interest. After the game was 6 months long, I think you had to commit to it, and after like 4 months we kind of lost interest because we weren't ranking very well on a national level. So we were like, okay, we're not going to win this, because we were, after the winner got a trip to London. So
Oh, wow.
we wanted to go to London more than understand the game. If we would have understood the game, which would have been real trading, then we would have been in a way better position for life. But we were just looking at the trip to London. So we didn't get it the way you did.
Yeah, and I've always loved it. I mean, it was always something. I still, even to this day, when I glance upon a newsletter or happen to catch something. I don't watch much TV, but if it's on a TV at a restaurant or like at the mall or something, and something's coming across the thing, I always find fascinating the business strategies, the plans. Over the course of my life, the companies I've seen come and go. The high flyers that were all the rage. At one time, then a couple of years later, they're out of business, and then you see the companies that have stood the test of time. It's just always been, to me, more fascinating than any mystery novel or romance novel. It was always the most exciting thing to learn about what companies are doing. So I guess very nerdy of me, but it was always something I enjoyed.
So is this something that you would do with your own kids, where you would try to nurture their money mindset this way?
Yeah, we've been working with my son. He's 15. He's not particularly interested. He's more of an artist. He'd rather be off, drawing his graphic arts type of stuff. But he does listen into some of our phone calls, and I'm surprised how astute his questions are. He asks very good questions. More than just, what did that term mean or what does that abbreviation mean? But I've heard him say, why did you ask that question? Because I know you knew the answer. Why did you ask it? Like, a little deeper into, how business works. So, I have hopes for him yet, even though he'd rather be out drawing, Japanese manga than, carrying through a 10K right now. But, he's also supposed to enjoy being a child, right?
Yeah, I think it's in generally, like, do we want to raise children that are genuinely happy, or do we just want them to follow in our footsteps? That's something that was a big discussion in our family, because we had like 130-year-old business. And then the question is, what's more important? Is it what you would like to do in your life and being happy and bringing that joy to the world? Or are you supposed to carry the legacy and maybe do what the family thinks you should do?
Wow, 130 years. That's amazing, man. That's amazing. Yeah,
Yeah.
I mean, we have a family business, but it's always been more of a choice if my son would ever want to join the local business that we have in Hawaii. And then, these new businesses that I'm working on that are more, in the financial sector. Again, it would be entirely, if you wanted to. I don't believe in bringing somebody in whose heart isn't into it. That won't work. Yeah, I
Yeah.
hear your point. I hear your point. I think with real estate, though, many people have proven that it can be, you can do your passion and still do real estate. You can construct it in a way that you can balance your hours if you so choose. I think it's a little different than some of the other things in the finance world. Like if you're going to be a professional trader, within
You have to,
reason. I'm not seeing that you're going to do this as a hobby.
yeah.
It's going to be it's going to be mostly all consuming within reason for most people, not everybody. I know one of my friends, Tom Basso, he's a published author, and he's got it down to I think 30 minutes a day or something. He still makes an insane amount of money, but he always reminds people it took him 40 years to get to that skill level. But I don't think most young people starting out are going to be able to do it as a hobby and be able to put the electricity on, put a roof over their heads as a hobby, right?
I think most young people want to start at the 30-minute mark without putting in the 40 years for just about anything. That's something I'm seeing with a lot of where I feel like this whole instant gratification, everything, they try to apply it to their career and their financial outcomes in the same way. And it's like, they're comparing their own trajectory with somebody like, yo, but this person already has built that. And like, yeah, it took them 35 years. Are you willing to put in 35 years? And maybe given technology and everything, you can do it in 12 and a half, but at least the decade of something you have to put in.
Mm-hmm. Yeah, it is funny. I think it was the author Simon Sinek was lamenting he was meeting a young person in some corporation. They said, we're very dissatisfied and unhappy, thinking about quitting because I'm not making an impact. And I think he had asked them, they looked quite young. He had asked them, how long have you been at this company? And I don't, I'm paraphrasing. I don't remember exactly, but it was like 3 months or 6 months or something obviously a little ridiculous. And he was like, whoa, 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 whoa. You just got here. You're going to have to earn your stripes. It doesn't happen overnight. You're not going to make an impact in the world and in this company and in your career like in a couple months. Like you just graduated college, go learn the ropes, or cut your teeth, earn your stripes, and then we'll talk if this isn't the career move for you. Not that corporate's for everybody, but I appreciated his initial reaction was, good Lord, slow down here. You're not gonna. This isn't measured in months. This is going to be measured in years or decades. And yeah, you're right. Real estate in particular, people. I've seen how many people come and go. I've seen so many people come and go. You could look, as you could look at 100 properties and maybe put offers on 5, and you might get none. You might get 1 or 3. I mean, if you're not a person with a lot of perseverance, this can be an industry to chew you up and spit you out. The amount of hours that can be involved, and you get very excited on a deal, and at the 11th hour, it doesn't pass due diligence, or the rug gets pulled under, from under you, for oftentimes, reasons theoretically beyond your control. I mean, if it's going to be 3 or 4 setbacks or I guess stalemates, and you're going to quit, this is not the business for you to be active in. It is a rough business. There's many things I love about it too, though. I mean, I love that it's probably the most abundance mindset, community oriented business. People want to see other people succeed. There's so much money to be made that nobody's really interested in hijacking or submarining other people. There's just no need. There's just so much opportunity out there, and it's all about relationships, as you know. So I've enjoyed this business much more than some of the other businesses I've been in terms of just mentality, and in terms of the social aspect of real estate is by far the business I enjoy the most.
I couldn't agree more. I was so positively surprised at first when I saw how much people are rooting for you and trying to support you and taking the time, to help you maybe even win a deal, where they have nothing to gain from. And that's something I haven't seen in too many industries where, and it's that abundance mindset. And at the same time, you feel like, there's, as you said, it's not a limited pool where, we're trying to share $100. There's enough money to go around for everybody. And I think you can really see that.
Yeah, it's a constant theme I hear both in meetups and online. Mostly I'm on LinkedIn. That's where I spend, the bulk of my time interacting with people. And I mean, if I had a nickel for every time I've heard somebody say exactly, what you're saying, in my old industry, it was X. And now I'm in real estate and it's very strange. I can't believe people just come out of the woodworks and offer me help. Oh, I heard you're on this project. Is there anything I can do to help you? And the guy says, we're having trouble with X. Oh, hey, I know a guy. Let me refer you. And it's like, what? I don't even know you, and here you are offering to help me. When you've been on the other side, the older guys and ladies, when you've been through the trials and tribulations of real estate, you want to see other people succeed perhaps just a tad faster or less painfully than you did. And most of the people that are very successful, not everyone, but most of the people, they didn't do it themselves. They had a mentor, they had people that supported them. And, it's time to pay it forward. And that's really one of the great aspects about real estate. So I do spend a bit of time, helping people with no real, expectation of payback or reward. It's just so many people have helped me, so obviously I got to help them.
So what are some of the markets that you're currently particularly excited about?
It's funny, when people view real estate, I often, especially with newer people, we often have a problem with the first thing I want to tell them is stop reading magazines and don't watch the news anymore, because there's just so much bad information there. And then the other thing is just what I would call painting with too wide a brush, or too sweeping narratives that are, too big. Like one of the most commented pieces of advice that's not without merit, but it has its limitations is, just, find the next hot city, has, in migration, good government, job growth, and you're going to make tons of money. And of course, someone like me always has to come back and do the flip side. It's like, do you think you're the only person that recognizes this, and that maybe valuations and prices would be kind of cooked in the books?
Yeah.
At the same point, I don't, I'm going to tell somebody there's a reason why the cap rate is, unusually high, perhaps in this market, because that market's going to heck. There's a reason why everybody's leaving that market. So,
yeah.
But, that's the value trap. Are you going to go with momentum, or are you going to go with the value trap? And both strategies have their points. But to me, the thing that we always come back to is I would rather have an A manager in a C market than a C manager in an A market. Because what I've always seen is that a bad management team, from the humblest little single family home or condo all the way up to big institutional real estate, bad managers of property will destroy a deal. You will get so much aggravation, lose money. I've never seen anybody that will hold on to a property for a long period of time if it's constantly a headache and thorn in their side. So that was the first mistake that I made, and it always resonates in my mind of when people send me deals, it's always like, that's cool, bro, but who's managing this property? It's a business. This isn't an asset. The bull markets don't last forever. There's, especially now, it's come to fruition. Operator excellence and actually being able to operate the business and execute the business plan. Those two things have never been more critical in the last, several years. 5 years ago, you could buy a property, repaint it, put some flooring in, raise some rents, and turn around and make a lot of money. Those days are not, here right now. The deals that are going to make money now are the people that are, one, buying it at the right price. That never changes. But you're going to need people that actually know how to properly manage the property, manage the asset. And I think that's where the divide is really coming. And then, of course, and everybody knows it is, the groups that just considered, oh, well, free money and easy money will last forever. Interest rates could never go up, and they didn't buy cap rates or these types of things. There's a reason why they're going to fail. And, just that assumption of the world is going to stay constant. Anybody who's old enough to remember the GFC or earlier, would remember that, credit does freeze up. Black swans do happen. COVID, I mean, all threw a monkey wrench in a lot of people's plans. These are things that I think a lot of investors aren't, even after all the warnings we can give them, they're still not, I don't think, fully cognizant that just because somebody posts on LinkedIn 2x multiple, EM, 15% IRR. This isn't a bond. They're not guaranteeing you this. These are
Yeah.
projections and estimates. It drives me nuts where I'm trying to explain to somebody, okay, you have two deals and you're all excited about the one that's a 17% IRR. Let's just make up a fun example. And there's two deals you're looking at. The other one's 15. So for a lousy 200 basis points, you're going to chase deal two. And that's it. Like that's the entirety of your thought process. And one is a 1960s building and one is a 2002 building. One is in a C-class market. One's in an A-class market. One's by a bunch of dentists and doctors and an attorney who've never really owned commercial real estate. Another is by a seasoned team. Are you sure the one that's 200 basis points higher on their estimate, you're sure that's a better deal? I mean, it sounds comical and funny, but I can't tell you how often, I see it. And it is just, it behooves all the industry professionals to sit them down and say, great, don't invest in my deal. That's fine. But please let me at least explain to you how this industry works so you don't go and lose, all your money. A lot of it is the same people that were chasing inappropriate stock investments. And then they ran to crypto and they chased inappropriate crypto investments. And I'm not against crypto, by the way. I'm just saying there's a way to invest in crypto and there's a way to blow your money. And they're not created equal. And it's the same people that, were thinking that Cathie Woods from ARK Invest had suddenly was the new guru and that Warren Buffett had lost his way. And, she went up, then she went down. Warren Buffett just kind of chuckling along. And when they had that, I forget what magazine it had. It was a cover and it was like, here's a chart and, has Warren Buffett lost his way? And I'm thinking, come on, man, he's probably forgotten more about investing than she knows. And no slight to Cathie, but it's like, really, you're going to compare her against Warren Buffett? A couple of lucky quarters or years does not an investing career make. It's just, I think the history of investing and having the understanding that what's happening now or what recently happened, that's not something you can just extrapolate, into the future. If you're looking to get rich quick, as real estate is probably not the game for you. There's plenty other ways that you can, if you wanted to get rich quick,
Yeah, the other day we were joking that maybe Airbnb short-term rentals, that's kind of the sprint version of real estate, but it comes with its own level of headaches, frictions, and issues. And then all others are more like a marathon, and where if you have good stamina and you're patient, you will get rich, given that you build the right teams, and you have the level of experience you need to execute on asset management, for example. And that's something where I feel like we're still in kind of a pickle market. There's still a lot of cheapies out there structuring deals, and they're pointing back towards deals that were done in this incredible asset rush, where they haven't really done the lift. They've got lifted because everything was blowing through the roof. And now they have maybe even 5 full circle deals and they're pointing back at them like, hey, we've done this before. We know what we're doing. But the reality is when crunch time comes, they haven't done it and they haven't done the real lift. So I think that there's still something in the overall marketplace that will get washed through the system.
Oh, yes. And I'm loath to make predictions, but yes, we've not yet seen the worst days for commercial real estate. And some deals are going to fall and fail. I've already, unfortunately, heard of some people that have lost all their money. That's, we always talk about the two sides of the coin. When you talk about debt being so wonderful and leverage, it is a two-sided, sword. There is this aspect of when the bank calls and says, where's our money? If you can't pay it back, you have no money anymore. It's called leverage for a reason. It's always been, you hear people just talk about, it multiplies your money. There is this thing called risk. It's almost like we've forgotten the concept of risk. I've seen people look at a deal and say, oh, geez, the LTV is too low. I don't want to do that deal. And I've had to pull them and say, go slow down here. Explain to me, oh, I want this return. And how much risk do you want to take? Well, what do you mean? Did you not consider that the more LTV you take, the higher risk you're taking? You take too low, then obviously the returns are perhaps aren't good enough. But it's a two-sided relationship. It's not only just returns. You don't just throw the maximum amount of leverage you possibly can in every single deal. And I saw it when assumable loans first were becoming popular again. A lot of people initially poo-pawed them saying, oh, geez, I mean, they're 50, 55, these, lower LTVs. I would never do that deal. And it's like flash forward 6 months later, I know people that's the only deal they'll look at is one that there's an assumable loan at 3% or 4%. And it's like, oh, funny how that switch of, how quickly all of a sudden what she once dismissed, now you covet. I just, a return to comprehending risk and evaluating risk when people are making investments would be a very good thing. I don't think most investors do not understand the risk of the investments they're in. They grossly overestimate their risk tolerance. And I don't think they really comprehend fully the relationship between risk and reward.
Yeah.
And what's unfortunate to me is a lot of people don't understand asymmetry. If a one-to-one relationship of risk and return, like, oh, I could double my money or I could, go to zero. That's speculating. That's not investing. You're supposed to have much greater upside than your downside. There's supposed to be an asymmetric risk to the two. Whether or not, you're going to buy some, crazy stock or real estate. If zero is your downside, 100% can't be your upside. It better be 3, 4, 5, 100% or a 10 bagger.
Yeah.
And it's the same thing with real estate. It's like, if your upside is only maybe making 10%, but your downside is you could lose it all. Tell me again how this is a good, how this was a good trade-off. And then, someone will say, well, I needed the tax write-offs. And again, I love depreciation. I'm the first one. I love depreciation, but we don't let the tail lead the dog. You don't buy, anytime over the course of decades, I've seen people buy deals based solely on the premise of tax first. They've generally been a disaster in my life that I've seen when people are doing, because usually they're getting hit with excessive fees. The business itself isn't good. The returns aren't good. And they spend so much time trying to fight Uncle Sam that they would have just made more money buying a proper good investment with a properly run team than trying to be, I guess, too clever. So that's the other thing I always want to warn investors about is like, yes, you have to consider it's not what you make, it's what you keep. But if you overly focus on the taxes, I've never seen it work out well. Just never. It's over 3 decades of, dealing with my relatives, my parents, my friends of my parents, working professionally, my own investments, just anecdotal stories. I've not seen it when people are too focused on tax that it works out.
Yeah. And I think, it's a dance. It's like you have to focus on what you make, and then you can also focus on what you keep. But, there is only so much you can save on the keep if you don't make.
Exactly. Yeah. It's just these funny concepts of balancing things. A great example that frustrates me is when I hear people say, I don't like development. And I'm like, okay, that's interesting. And they're like, do you? I'm like, I don't like it or hate it. It's very deal specific and it's market specific and operator specific. Or, when someone says, I don't do California. I forget it. What is it? The 5th or 7th largest economy in the world.
Yeah.
Now, I won't get into it. Politically, I'm quite, let's just say, politically incorrect in my own political views. And I will invest in California with the right team in the right market in a specific niche.
Yeah.
So San Diego in particular, one of my friends, he does very well in San Diego. He doesn't own and operate. He only develops. And the permitting that they have there is very friendly to developers. Where I live in Hawaii, and he's come to visit me. He loves Hawaii. He's here multiple times a year. He can't build here. The permitting situations are so diametrically different. It's like printing money in California, and it'd be like death by 1,000, cuts and government strangulation where I live. So for him, he's going to invest in California, but he's not going to own and operate. I mean, we won't get into the politics of California, which I don't think are very business friendly or frankly sane. But for a developer in San Diego, it's absolutely phenomenal. So when I hear somebody say, I don't do development or I don't do California, it's like you're blocking your mind off to opportunities to make money. And they say, Andy, do you really like development? I said, no, generally I'm more of a cash flow investor. Now, development's a very small portion of my portfolio, but I will do it. And they say, do you like California? I'm like, well, clearly you've met me, and within 5 minutes you find out I'm not exactly the most politically correct person, but I'm not going to just go like this and pretend a market, that's the fifth largest, seventh largest economy in the world doesn't exist. And within a state that large, I mean, it's larger than many nations, as if all these different cities and counties aren't going to have different, jurisdictional rules with regards to permitting. That's just like one example that I often harp on. But those kind of things where I think a lot of investors just overly focus on what they're told as if they're like universal truths. Not that there's a lot of value and truth to certain things, but you can't take it to an absolute part where it shuts you off to examples. Other opportunities. The other one is like multifamily. I love multifamily. It's the bread and butter of most people's portfolio, but it is not the only investment out there. There's going to be times where other asset classes are going to be more compelling of value. And we're depending on where you live or who if you live in Michigan and your best friend or your brother-in-law happens to be brilliant at strip malls, and that's what he's good at, and he's been doing it for a number of years, by all means, invest with your brother-in-law in strip malls in Michigan, because he's very good at it, or she's, your sister-in-law, she's very good at it, and they're disciplined. They know when not to overpay, and they're willing to let a year go by and not overdo it. And then when opportunity comes up, they're going to go do it. By all means, that's what you should be doing, instead of just randomly investing with some guy in New York City in an apartment building in Florida because you met him on a Zoom call. But because you were told Florida's hot, multifamily, the big joke about multifamily is people got to live somewhere, right? As if that's an investment thesis. I mean, of the two, I'm creating kind of an absurd example, but it's a real example in the sense of like, yes, multifamily is great. Yes, attractive growth markets are great, but the most important thing still will be the operator. And there's opportunities all over. This is a humongous nation with trillions of dollars in real estate. Like, you don't have to only buy an apartment building if that's not necessarily your best opportunity. That's just, all my multifamily friends are going to send me hate mail now on my LinkedIn DM, but it's okay.
I'll cut that piece out and send it to them.
Yeah,
No, I'm
great,
just kidding.
great. And I always caveat it with, it's the bread and butter of a portfolio, and still I get hate mail. It's just funny. Like, when I tell people I'm invested in office, they think I'm absolutely insane. And I'm telling them, that's like, am I buying all office? No. Am I buying all geographic regions? No. Am I buying it through myself? Absolutely not. I would invest with a very specific group. They've been doing it for a long time. They're actually second generation, and they pick and choose their spots. They haven't done a deal in quite a while. They haven't found anything that would suit, their valuation metric. But most every asset class at the right price is attractive to me, within reason. Within reason. If you said to me, Andrew, I got this land in this state, and we only have to spend a few million doing environmental cleanup. It's got toxic chemicals underneath it. I'd be like, "Ooh, okay, Hans. Let's just slow a roll here." I would still take the call, of course, because I have a rule of that. I always will listen through it if I respect the person. But I'd be like, okay, this might push the boundaries of my at the right price thesis, correct?
Yeah.
But I just find it funny that people will chase the narrow-mindedly one asset class and forget that there's other things. So I'll meet investors, and we'll discuss the depreciation schedule for a commercial building being, what is it, 29? I believe it's 29 years, and residential is like 39 years. And when I ask them, did you know a car wash is 15 years? They're often shocked. They didn't realize why institutional investors love car washes, and it's only now becoming more popular amongst LPs. Dan Hanford's done a great job with passiveinvesting.com. My friend Adiola is be soon launching his own car wash fund. There's some people doing good things in that industry. Then I'll ask them, did you know an ATM is 7 years? And they're shocked they didn't know that. And it's like, I'm not saying that you shouldn't build a competency and a focus on an asset class. That's fine. But to be blindfolded and not realize that there's other avenues to wealth would be foolish. Because if for some reason ATM suddenly had this tremendous valuation and investors were inappropriately not investing in it, and you could get a better deal, it would help to know that it exists, it's a thing, and then two, 7-year depreciation is very attractive for an investor.
Yeah, but I think there's an educational curve to it. Like I would say similar like your journey. We all maybe are first looking at stocks, or I remember for myself. Actually, before I bought a stock, and that might have not been the smartest, I did some private investments into startups. So I went through the highest end of the risk scale, which wasn't the smartest move that I realized.
Yeah, look, you turned out well.
Yeah, it turned out well, but it was such a heavy downfall in a way that like the learning was so immediate, the pain was so big that I was like, whoa, like what did I like majorly do wrong? And without ever comparing myself to him in any way, but it's kind of what Ray Dalio went through, how he had that very painful experience, and then he was like, okay, now let's understand how we can play this game with the proper risk ratio, and as you said, you don't want to get 10 bips and risk it all, which is kind of what I did
That's not a good trade-off. No.
Yeah. Which is kind of, it wasn't even a 10x on the table. Well, one out of the two was, but one, and now in hindsight, I'm like, wow, I was dumb. And the funny thing is, my family actually warned me. Like my family was like, I don't think that's smart. My partner back then saying, but I just had to learn it by doing it myself, and I had to go through the valley of pain myself. So now my risk aversion is completely different, and the way I look at it is different.
Yeah, you're much more honest with your risk tolerance. Now you actually know what your risk tolerance is. That's a good thing.
Yeah, before I just didn't know. I was like, okay, and it was the lack of opportunity that kind of at least psychologically pushed me into making the deals. But then I realized that is also true for LPs. There's people who don't know other syndicators or who don't know good syndicators, and they will go with the bad syndicators because they are their friends, and they will go with them because they're the only people they know, and they will make it sound like there are no other deals to go around because it's, at the end of the day, it's a relationship business. You don't get to be part of the deals from the people you don't know. And when it comes to money, it's a lot about trust, even if maybe you see an advertisement by a company that has more professional run operator and you're an accredited investor, but you don't know them and you're not used to building professional investment relationships, you will still go with the guy who might be the bad operator.
Yeah, it's a funny thing. We have a LP group that I'm a part of, and we have meetings occasionally. We do a lot of just group emails where people will say, does anybody know Johnny? Or I'm looking for this. Does anyone have a recommendation? We do a lot of that just in group emails. And one of our more senior and very experienced members, he always has this gripe about he wants someone with 20-year track record, and they've done this. And I don't mean to be rude. I'm a very given to being a smart ass. I'll admit it. I often giggle because I'm like, you're looking for a unicorn. And he's like, well, what do you mean? I said, well, if someone's been doing this for 20 years. They already have their investors. They're not advertising. They don't need me anymore. It's hard to even find such people. You'd only get them, through a referral. They're not going to be on LinkedIn. They're too busy operating their existing business. They don't need to be on LinkedIn, anymore. And then one of the other issues that we often face is that a lot of syndicators, frankly, they only want to be doing this for a little amount of time. So, they're 5-10 years, make their money and retire. So, like we're going to be cycling through certain syndicators over a course of time. If you or I were the typical person, and after 5 years we've had enough success, or 10 years we've had enough success, nobody's going to want to stay in the accredited market if we're being clear and serious. Your next level would be to go to family offices, and then the next level would be going institution. So when someone says, well, I want somebody with a 20-year tremendous track record of success. Yeah, well, they don't want you anymore if you're an accredited investor. They've already kind of leveled out. Like, there are some kind of funny dynamics of the way the industry works, and it's not a negative or a positive. I'm not being pejorative about it or trying to be facetious, but if you understand the industry for what it is, it gives a little context to, this desire of, I want someone with 20 years, they've never lost money, and every single deal they've done has made money. Okay, like, if that person exists, which one, that's a bit out of an outlier, but even if that person exists, he doesn't want your lousy 50 grand. You're not worth his aggravation, because he's not going to, he doesn't want, if he's raising $1 million, he wants one check writer. He doesn't want 20 check writers that he has to now deal with in terms of headache and aggravation and have an investor relations person. That's 20 K1s to put out versus one K1. You know what I mean? These are things that I have to kind of humble my LPs with. I'm not saying just willy-nilly invest with anybody, but if you have to have your expectations at least reasonably tempered by what's available in the market. I mean, if you're thinking you're going to invest with the Warren Buffett of real estate as an accredited investor, I hate to let you in on it, but that's probably not going to happen.
Yeah. And it makes perfect sense when you lay it out like that, where I'm like, okay, somebody with that level of track record, that level of experience, they have access, they can have one conversation and raise a completely different level of money. And why wouldn't they do that? Like, if you can have a single conversation and raise institutional level funds, like, why wouldn't you do that over having hundreds of conversations? Mm-hmm. And then also the complexity of having less sophisticated investors who might be accredited but don't have the understanding. You have to talk them through the deal structure. You have to talk them through things which is second nature to people on the institutional level.
Yeah. The other issue too is there's this real difference between expectation levels and the relationship between risk and reward. When you're dealing with much wealthier investors, it's very different than, let's just say, like, someone worth 5 million and someone worth 50 million. Generally speaking, we're going to make some generalities here. They're going to be very different investors. So a lower investment rate with less risk is going to be much more attractive to the $50 million person, family, the second, third generation family. A lot of times when their net worth is in the many tens of millions or hundreds of millions of dollars, they don't want to lose money, because they understand that losing money slows down the compounding effect. And they're more realistic about, these double-digit returns, they're not sustainable. So they're not as easily enticed by big returns, and they don't want to take on risk. So, like, when I was giving you the example of the people that I invest with in office, most of their investors are very wealthy people. And the returns on our office deals are lower, but they're also much, much lower LTV projects, significantly lower. And just the whole way it's set up, it's set up to not fail and to make money. That same pitch doesn't work well with the 45-year-old engineer, electrical engineer who wants to make a big amount of money because he wants to retire in the next 10, 15 years. He wants that 15, 20% return. When I tell him lower LTV, he's like, like we were just talking about earlier, he's getting annoyed at me now because he wants to retire in so many years. And you have to wonder, like yourself, like, is constantly chasing a higher return always in someone's best interest if you're the passive investor? And I think, people are going to start really coming to see it in the next few years when they hear about their friend that lost all their money in a real estate syndication, or, that deal that I have, a couple deals I'm not thrilled about, and, not necessarily always to the fault of the operator, but there will be a few that, we'll go full cycle, years after we expected. And in terms of, if you do look at an inflation adjusted return, we never got the distributions we wanted. It finally sold. Yes, we didn't lose money in nominal terms, but whatever your expectation of inflation is, if we break even or make a little bit of money in 7 years versus the 5, and we didn't get the distributions we thought we were going to get, and it didn't really make nominal money, we actually lost money in real terms.
Yeah.
So I think there'll be a wake-up call for a lot of investors to realize, one, you don't put all your money in one syndication or one syndicator. And then two, just being more realistic. There's going to be times you're not going to make money. Even the best syndicators have deals that struggle. And particularly now, some of it is, self-induced because of that understanding of debt. Short-term debt with no rate cap is something that's like the kiss of death with me. But the two big issues I think investors are really not understanding is property taxes and insurance. It's not going to be just Florida and Texas, and they're the most extreme examples. But I think a lot of syndicators in their underwriting now, it's hard. How would you possibly guess that your insurance could double or triple in 1 year? I don't even know how you would underwrite that. But all those coastal cities that are, from Florida all the way to Texas, there's quite a few coastal communities along that path that aren't getting the recognition that they deserve in terms of environmental risk. Even in Colorado, I've seen tremendous increases in insurance, and that's not a coastal market, but it's just forest fire risk. There's a lot of communities with tornadoes, you got hurricanes, you get different things. They're underestimating in their underwriting the increases that they're going to face. The other one, of course, would just be property taxes. The classic rookie mistake is to plug in last year's tax number into the future year's taxes, and then you're going to, because your guru's template or calculator, their little Excel spreadsheet tells you, oh yeah, just plug in the number, the spreadsheet will do it, and the national average is 5%, and you're like, wait, there's 50 states. I'm pretty sure all 50 states have deviations from national average, and some are at national average, and some are below, and some are above. Like, really, you could just plug it into a spreadsheet. My close friend Jason Williams, who does a lot of coaching for underwriting. I think if he was here, his eyes would be bulging out, his face starts turning red. That just like irks the bejesus out of him. This idea that you would just plug some number vapidly in a spreadsheet and it's a national, you just use some national numbers. Like, you can't even do that by the state level. Every county is different, can be wildly different. And the headline number that you see in that U.S. News and World Report number, that's a state level. That had nothing to do with the county level. And if you pull apart your property tax in a lot of these places, all the special assessments for Save the Spotted Owl and Save the Library, and, well, we didn't exactly properly budget for pensions, so like, well, you're going to contribute to the the firefighters and the police and the this fund. The percentage of those taxes of your tax bill that can be all these special one-off line item expenses, I've seen it as high as 40% on some of my tax bills. So that headline number in U.S. News World Report saying so-and-so southern state is a low tax state, you look at your property bill going, okay, this is not what U.S. News and World Report told me would happen. One of the classic examples would be Indiana. This is one of my biggest pet peeves with the mainstream media. is they'll report it as being this low cost state. It's a 1% property tax. And then when you go and meet a broker and you find out, no, it's a 1, 2, 3 state. So it's 1% for homeowners, it's 2% for absentee owners, but for commercial property, it's 3%. Low cost state? Really? I was an investor. It's an investing article. But you wrote an article based upon what homeowners pay. I mean, that irks me, to no end. And this is where, I try to tone it down because I've gotten in trouble in the past for it. But, I'm often a little too open with my disdain for the mainstream media. But I mean, these articles in many of these magazines, they're written by 23-year-old college graduates from Ivy League universities with majors in comparative literature, and they're living in their mother's basement. And they're churning these articles out fast, right? Because they're trying to get paid, right? They got to churn out articles. And I'm like, why on earth would I be interested in, little Johnny's articles about real estate? Because he went on a couple statistical websites and just churned out a little article, but he has no real world experience in the business. He doesn't understand the conceptual framework of it. He's never owned a property. I'm supposed to take this with any grain of salt. Like I don't really spend much time at all, frankly, reading or having any interest in the news media. And then the magazine articles are probably, frankly, the least of my bane of hatred. I mean, they're annoying to me, but they mean well, at least. But CNBC or MSN or, these different, television shows, they're entertainment shows. I mean, Jim Cramer, laughably amongst stock people, is, the worst advice giver possible. I mean, it's almost, it's staggering to me that he's even allowed to be on the air. I mean, sorry, Jim, if you're watching this, but I really do feel you should be handcuffed and let off the stage and not allowed back. I mean, it's despicable what he's done and got away with. It's entertainment. I mean, it's bad enough to the point they created an inverse Kramer ETF. It's literally that's how bad it is that somebody spent many.
How's that performing? I want to see
it's
that.
actually doing quite well. But they were a serious investment firm spent tens of thousands of dollars registering it and going through the SEC process to make a point of just how abysmally horrible and unethical his entire ridiculous entertainment is. I mean, it is just embarrassing. Guys like him just should not be on air. And I won't name names because I don't want to get sued, but we have them in commercial real estate, in multifamily. We have certain gentlemen that love to do their videos from their private jet, and they give investors terrible returns, and they're under investigation, and they do a lot of things that are unethical and frankly illegal. And their time, will come. And there's several in the industry that I'm not going to name, but God, I just can't stand them. And everybody in the industry knows them. But unfortunately, they're still finding victims. And, it's because people watch a video and they see a lifestyle, they click a YouTube channel and they resonate with a former pharmaceutical salesman, I guess, or, a guy who used to be a used car salesman, or a shyster who used to sell internet, ETF, NFTs not so long ago. And they don't do their due diligence and they don't ask other investors, hey, what do you know about this guy? And they get misled. And it's very unfortunate for our business. It's very frustrating to me. And, I think all the good operators and the good and honest people, which is the vast majority of the industry, it's really unfair that a handful or a dozen, what I would consider really bad actors, gives us a bad name.
Yeah. But I also think it's part of, like, if you look at society at large, and you can do that for the last probably couple millennia, you always had those rotten apples. You always had people who doing their own shyster stuff. And then, so I think that even if people, there's some people, it's very interesting. There's some people who will get burned and they will remain burned and will never touch anything again. They'll just get hurt. And they'll never try to invest again. I've seen some of them, and actually I've seen them unfortunately give that mindset to their children. Worst thing.
Mhm.
Like I have some friends, they won't invest a penny because their parents lost money on investing, and they just didn't know what they were doing. So there's 2 generations burned by
Oh, wow,
that.
that's sad. Yeah.
And then, but I think at large, you get burned once if you're sincere about it and you understand that you have responsibility for your own actions, and you take that into account. You're like, okay, I was uneducated and dumb and I trusted the wrong person. How can I get risk? How can I take that risk out and make better judgment? How can I find people in the industry who have a track record and who are willing to take my money? And I can check references, and I can make sure that they're good steward of my family's money too.
Definitely. Yeah. I'm often asked about that, and there's different ways. Some people reading a book is how they learn. Some people, it's better that they watch like a YouTube video. I think those are like the beginning steps, personally, to me. The best steps for me would be either in person or online, or some combination of joining different groups. And I wouldn't say just one, but groups. And just slowly, you don't have to go crazy, but like meeting more people and getting to know people and getting referrals and building up your network. That's really the best way to do it. And when someone says passive investing, I always find that kind of funny. There's active and there's passive, as if there's this black and white distinction between the two. And to call it passive, I just don't think you're really going to be you're ever going to be totally passive. There's degrees of activity. So to call it passive, I think, is a misnomer, because you're going to have to spend the time to watch the presentation and to have at least enough base knowledge to understand the proper questions to ask for, or what to know what red flags are. Hans, we'll just give like the classic example. If somebody said, we're going to have a lower cap rate at exit than we're going to have at entry, 99% of investors are going to laugh at that syndicator and say, I'm hitting junk, send to junk mail. Never contact me again if you have that in a presentation. But a new investor might not know that. That's not passive anymore, though. You need to know how to read a presentation. And it's not quite active. So, it's degrees of activity. And I'm not asking people to create a second job for themselves. But if you're going to invest $50,000, $100,000, or you're going to do this over, a course of years where you have a budget, let's just say at $50,000 a year, you're a young double income, couple, and you both do well. Okay, but you're not going to just be able to willy-nilly, wire off 50 grand. You're going to have to learn how to watch a presentation and vet people. And it's going to take some effort, not a whole lot, but the average American spends more time. This is actually funny, like buying appliances.
This is tough. Yeah.
Than their investments. And not to say just, show up to Home Depot and just buy the first washing machine. The idea that, I don't even know what a washing machine costs anymore. Sorry, but like, let's just call it $1,000. You're going to, you're more, or $1,200. We'll go with a high-end washing machine or something. You're going to spend more money on your dishwasher, your $1,200 dishwasher, your $400 dishwasher. You're going to read consumer reports for hours. But a guy that you watched on YouTube for, a couple times over, several months, you're going to go cut a $50,000 check to? That's insane. And it sounds ridiculous when I say it, but that's honestly what happens. That it's kind of sad that really is somehow the mentality of the American mindset, which I'm still just fascinates me, that you would spend more time on a dishwasher than your $50,000 investment,
There's another statistic just like that I love. It's like people spend more time planning their vacations than their retirement.
Mm-hmm. Yeah, no,
I'm like,
that's definitely true. I never thought about that. That
wild.
is really, that is true, and that's fascinating. Wow,
that's wild. Like, imagine you might end up in old age poverty, and you don't really look at that. And I find that really interesting. That there is a reason that you can go to different countries at different millennials again, and you will find a single-digit percentage of society being financially independent, and you will find a large chunk of them being employed, and then another chunk unemployed or old age. And that single digit financial independence, more or less the same, whether you're now in Germany or you're in the United States, it's, and I think it has one thing to do. You have to have that kind of far out financial outlook, or it's like where you understand that even something that's 20 years away will still eventually become today, so that you understand that one day you might sit there and you might be old and poor. And you also understand that, I don't know, if you eat a bag of Cheetos every 3 hours, that also has a consequence down the road. And the thing is, I feel like the majority of people cannot connect that. They don't understand that the credit card debt burns them out immediately. The compounding of that, the negative compounding of that, is so incredibly painful for their financial future, but they just can't see it. They can't see it. And in the same way, they can't see what it means to invest for 20, 30 years out. And that actually like you said, a decent couple that has W-2 income, they can become financially independent within a reasonable amount of time and live a really good life.
Mm-hmm. Yeah, like you were mentioning, a lot of it is societal and familial. It's about role models. And it's a funny story. It's Fidelity Investments. When they looked up what their most successful clients were, it was their dead clients. This is a true story. So they would find out that like Johnny had died and the account was still sitting there. It was in limbo, or it was still waiting on heirs, or like the heirs had just let it sit. And the people who did nothing were outperforming all their guys that, every 6 months or every year or every so often were trying to rebalance their portfolio because they were so brilliant. They knew that next year the S&P was going to be down, but Europe was going to be up. Or this is now going to be the year of Japan or China, or now emerging markets, or now bonds aren't going to do well. And oddly enough, the accounts that did nothing, that just held, outperformed all their accounts. The highest correlation to success was inactivity. And it's just a very humbling thing. I'm not saying that people should just, blindly buy the S&P and, open up their statement 30 years later and okay, now I'm going to retire. But there's an element of truth to even real estate is, they see real estate averages, X% a year, right? But it doesn't go smoothly. There's years it doesn't do anything. There's years it goes down. There's years it goes up tremendously. And the percentage of people that are going to be smart enough and active enough to not be involved in the years it goes down and only be involved in the years it goes up, maybe they think more highly of themselves than I do, but I don't see most people being able to do that. Whereas like what we're talking about is you buy a property at a price that cash flows now, you own it for a long period of time. Statistically speaking, if over enough period of time, your odds of doing well are very, very much in your favor. That's why, real estate has been the number one generator of wealth of millionaires in this country. The tax laws are favoring real estate. It's one of the very best, collateral sources to get good leverage. And then just in general, it goes up over time. It does cash flow. So I just find it funny when I see people that are in a rush to hit it big. And I'm like, you had the golden goose. You have this largely stupid proof investment. How did you go and stupid it?
But you have to be patient. You have to see and zoom out and gain perspective. Where are we in the cycle? Like you can't rush it when you're in the wrong part of the cycle. Mm-hmm. There has been an incredible period we just came out of, where many people were able to rush their wealth and became fairly rich in a short period of time. I mean, there were properties that got flipped in 18 months, and where the sponsors made a killing, the LPs made a killing, and everybody's like, what's going on? But this is not the reality of the long-term market. As you said, those gains are spread out. And the reality is also, we don't always have a crystal ball, and we don't make the perfect calls. And statistically, I think that's been proven over and over and over again. Whether it's stock or real estate, there will be maybe 1 out of 1,000 gorillas who flips the coin and has had 10 times, but that will be that one outlier, and we will celebrate him like he's a genius.
Mm-hmm.
But the vast majority of us will just get it wrong.
Yeah. Like the constant theme that you and I are talking about is just understanding the history of things, not overpaying, not all your buddies at the country club are talking about how much money they're making in real estate. So you pile on into, that's a mistake in any asset class. And, just really vetting the sponsors correctly, that, that you're buying deals that make sense, that actually pencil. And I'm not asking people to learn how to be an underwriter. That's, ridiculous. You learn just how to spot check underwriting, but you get a sense when people are making the numbers work versus the numbers work. And, one of my biggest pet peeves would be when you ask a syndicator if they have skin in the game, and their answer is, "Oh, I have sweat equity." And I'm just like, no, that's just not going to cut it with me. Unless you have money in the game, it's just not the same as my money in the game. And if you have 50,000 in the game and your acquisition fee is $100,000, you didn't have skin in the game. Come on now, don't.
Yeah.
And if you try to pawn that one off of me, that's not going to go well with me. Just be honest with me and say, Andy, we have so many deals. I can't put, $200,000 in each of my deals. I have a lot of deals. Just tell me the truth and we can discuss it. But don't tell me, oh yeah, I've got financial skin in the game. And I'm like, okay, well, how much? And then I can do math and very quickly be like, okay, wait, that's really not an honest answer. So like, lose my email. Don't call me again. We're not ever doing business again. That's a quick way to get, to be, permanently on the poop list, right?
Mm-hmm. And by the way, that also goes to being that 30-minute a day guy. You have to have that experience. You have to have that relationship gets you there. It's all of the above. It's learning how to do the underwriting to the degree where you spot the red flags. It's also understanding the conversation, knowing what questions to ask. And all of that eventually gets you to the 30-minute a day, still building wealth and making money. But we have to put in that educational period and build that really deep understanding of what a good deal, what does a good operator look like. And then it also, there is markets where I know I cannot make money. Like I'm selling something right now in a market where I don't want to participate for longer because I know the way we run deals, we cannot make money. But I'm talking to a guy right now that I know he is the number one guy in this market. He knows it in and out. He's vertically integrated, and I know he will make money. And I know why he can make money. So kind of having that understanding of like, okay, there is operators in particular pockets that know how to make money. So kind of bringing all of that down, build that level of experience so that you can make good judgment and park your money well. And I think that's what it comes down to. And I think people cannot, you cannot shorten that learning curve. You have to actually learn it.
Yes.
You have to go and speak to people. You have to be on different meetups, as you said. You have to build relationships, and you have to have conversations about money and understand where people are trying to maybe get your money into a bad deal because they're trying to do it for the wrong reasons. And then you have to find the people, because there are many of them out there who do it for the right reasons, and they want to do right by you. And I think that also shows in underwriting. Like, see if there is a breath which shows that the GP cares for their LPs getting their returns before they make a big cut. And the structure is right. That shows alignment of interest. And that's all of that is something I want to see in properly structured deals.
Yeah, I mean, a lot of LPs have no idea what split, whether it's 80-20, 70-30, all the way down to 50-50 is a good split. And there's some celebrity syndicators with splits that are just, not fair to the LP. They don't, I've seen acquisition fees that are just absurd. Management fee, asset management fees that are just, ridiculous. And if a person hasn't seen enough deals, if you've seen 10, 15 multifamily deals, in your mind, you're like, okay, it ranges from this to this. And then all of a sudden you see, someone saying they want to, let's just be ridiculous, like a 7% acquisition fee. You'd be like, whoa. It's usually like, 1, 2, 3, depending on the size of the deal and the market and what's involved. Like, wait, 7? Like, how? Like that would be I'm being a little ridiculous here, but some people wouldn't even know that. They might think, 5 doesn't sound crazy. You might not realize that 5 would be, very much on the outlier high-end side of an acquisition fee. There was one syndicator that had an acquisition fee, and then he had like it was almost like a gym membership thing. Like they had like a sign-up fee or some ridiculous, dollar percentage they were going to charge all the LPs. And I was like, dude, no, just no. Like, you're done with me. Like, no. You can't do that. That's just dishonest. Where did you make this up? This is not industry standards. Like, no, we're not Planet Fitness or somebody. You're not going to hit me up with this fee and that fee after your acquisition fee. Like, that's just ridiculous. Just no. And what it was he was just trying to kind of blow it by people. Because his percentage was low, so he would get people excited. And if they didn't read the fine print that there was these one-time fees, and you're like, come on, man. Like, that just tells you about how that relationship's going to go and how he views you.
Yeah.
There are people I've worked with that I've made money with that I won't reinvest with because they made it very clear to me that they just saw you as capital. They didn't really give two rips about you as a person. And, while I don't need a Christmas card from you and, we don't need to go to dinner, if you just totally think about like how little can I give Andy or what can I get away with? How much can I, how much do I have to do to get his money? That's not a good foundation to be setting up a business relationship with. When things go, inevitably when things go wrong or hard, these are the guys that all of a sudden 3 months go by and you don't have an investor newsletter anymore. All of a sudden they're not giving you an update about the property. That's a pretty big, there's, one of many big red flags is when you get the sense that it's all about how little can I give the investors because I want to maximize how much money I make. Those usually that's a pretty good indicator this is not somebody you should be investing with.
It's also very short-sighted because, see, true wealth compounds in relationships. And if you have goodwill and you have good relationships, that compounds so much faster than the money you could compound in trying to make those kind of stingy deals with people, Like, imagine, instead of you coming back, maybe with even potential other friends and family members that are also looking for a good deal, that could be the positive compound. Instead, you also decided, I'm never coming back. So the guy constantly has to find new investors, and he's not compounding good relationships and goodwill.
And there are those in the industry, like you say, and some of them are the celebrities because they can get away with it. And then there's others that it really is just it's late in life. I want to retire. This is my big score. And they really don't care about their investors. And it's not always easy to tell. They might be very personable and convincing on a YouTube video. They might even be very convincing on a webinar. But, facts are facts. And when you're reading, when you're going through a PPM or you're going through the webinar, you're looking at all their flyers. Certain facts will speak out and they'll tell you who people really are. And when they tell you who they really are, you have to listen as the investor. But again, like you were saying, if you don't have the baseline education, it'll go right over your head. You wouldn't even know what to look for. So that's really critical to get that baseline education.
Well, Andrew, this has been a really interesting conversation. One of my closing questions usually is, what do you consider a life well lived?
That's a great question. I don't know. I hate to tell people how to live their lives, for some people,
it's your definition of it.
Yeah, but everyone's is different. But if you're waking up in the morning excited, that's the life well lived. When you wake up in the morning dreading going to whatever it is you do for the day in terms of your vocation, or you're dreading dealing with your spouse or your children or your health or whatever it is, when you're dreading life, that would not be success. So you can have all the cars and private jets in the world. If you're waking up dreading who you have to lie to today to continue the Ponzi scam, you're not a success. I mean, if you're really excited that you're off to your big fancy office, but your kids are screw ups, you're not a success. If you're a terrible spouse, or person, human being, but you've hit material wealth, like, no, you're not a success. So, many times I think in our society, we put people on pedestals that really don't deserve it. That college football coach that his two kids are drug addicts, and he's a bad husband, and he's won a couple Super Bowls. Like, I'm not in any way diminishing his professional accomplishment or anything, but at the same point, I'm not really looking to watch a video, a motivational video by him. I don't really care to read his biography. I'm not really interested, frankly, in him giving a keynote speech to me, because in my and it's not for me to judge, but just what I would know about like said football coach, and this could be any football coach out there, and not to pick on football, basketball, whatever.
I get the example.
You're
there
not,
is
not to me what a success is.
Yeah.
So, gentlemen that I know that have reached a certain, professional pinnacle, a wealth pinnacle, but have managed to be a good wife or a good husband, and they've done things the right way, and they've done it ethically, and they've enjoyed what they do, and they're paying it back by giving advice and helping people and mentoring people. To me, those are the successful people. And that's an ongoing journey, and it never ends. I mean, it's kind of funny. Some of the older investors I know, they put in more time and they're more passionate about learning new skills and new things than some of the younger guys. It is kind of funny. Like, when you think you've achieved success, you're really not successful. It's really a never-ending journey. There's always stuff to learn. There's always stuff to give back on. So to think you're going to just get to some dollar figure, move to Fiji and sit on the beach and put your toes in the sand, and the party's over, that's kind of a funny idea of success. So yeah, I have no aspirations to retire and go golfing and go to the beach every day in Hawaii. I enjoy the beach, but you won't see me there 7 days a week.
I can totally relate to that. Like, to me, so much of what I do in around real estate, meeting people, even having those conversations with LPs and GPs, and to me, I don't consider it work, so I never would have to retire from it.
Yeah,
it excites me.
Yeah, I mean, it's fun. I love hearing new financing strategies. I love hearing somebody tell me about a market that I think is insane, and by the time they're done going, I'm like, wow, this person's figured it out. There's a way. There's, like you were mentioning, you can go to a market and you wouldn't be successful, but there's somebody who's figured out how to do it. That fascinates me. I have tremendous respect for that. That's exciting. Like, yeah, I can't wait to wake up and go to that meeting, the next day. And at 3:00, I'm meeting with, Steven, and he's going to tell me how he possibly makes X marketplace and X asset class work. That's fun. That's better than any TV show I can watch on television by far.
I can totally relate to that. Like,
yeah.
I mean, occasionally there's some TV shows that I appreciate, but in general, I'm like just so much more interested in having a conversation with you right now about all of this. Gets me so much more excited. I'm like just watching the next dull Netflix show.
Mm-hmm. Yeah, I find the real world is much more rich and entertaining than anything Hollywood can produce. Like, generally, there's not too much that's gonna amuse me to get distracted. Every once in a while it's fine, but to me, it's just I think most people are consuming way too much entertainment and could up their educational content. No one's saying not to watch the football game on Sunday, or they're if you and your girlfriend or wife have your favorite TV show, by all means, spend a couple of time and watch the show. But the average American, I forget what it is, but it's mind-numbingly, 20 hours a week of television, and you throw in, cell phone and Facebook and Instagram, the amount of mindless hours that are lost on social media and television and movies is a little disturbing. If they just cut out a portion of it for education and invested in their number one most important investment, which is themselves, like you were saying, they would have much better financial outcomes and better security.
Yeah. Well, we'll end it on that. Thank you so much for your time, Andrew.
I appreciate it. It's wonderful talking with you.
Yeah, likewise. Thank you for joining us at The Path to Wealth. We hope you enjoyed today's episode. Check out our upcoming guests and be sure to share it with all your friends and family that want to take their life to the next level of wealth.